Hello and welcome to our 2021 market preview video. 2020 was a year like no other and has left investors across the world wondering what the future looks like. Will vaccines prove effective in halting a pandemic that spread like wildfire across the globe? What will the impact of a new administration in Washington be on economies and markets? How much additional stimulus will be injected into the economy? And most broadly, will things ever get back to normal? While there are no easy answers to these questions, 2021 promises to be another volatile year, most especially until there has been sufficient rollout and distribution of vaccines to contain the COVID-19 outbreak that continues to haunt economic growth across the globe. Remarkably, 2020 ended up as a positive year for financial markets, despite a massive sell-off in the equity and credit markets during February and March. Paradoxically, 2021 may be a less eventful year, but at the same time a lower overall return environment, given that much of the optimism about economic reopenings and stimulus have already been priced into the markets. Nonetheless, there are a variety of factors worth monitoring over the next year, which will directly impact market returns. Similar to past years, we offer our 2021 market preview newsletters. Those are in-depth views of each one of the asset classes we cover. And today's video really summarizes the high-level points of each one of those articles. We hope these materials can assist you and your committees as you plan for the coming year and beyond. We hope it is a good use of your time. If you have further questions, please reach out to your consultant or any of us on the research team for further assistance. In terms of agenda, we will follow the typical agenda for this video series. We will start by talking about the U.S. economy, since that is the natural backdrop to the capital markets discussed on this video. We will then move to the traditional asset classes of fixed income, U.S. equities, and non-U.S. equities. Finally, we cover alternatives, hedge funds, real estate, infrastructure, private equity, and private credit. If you have any questions about these sections or something even unrelated to one of these sections, we've provided each analyst's email address on each section divider, as well as a general contact email at the end of this presentation. So please feel free to reach out with any questions.
Hi, I'm Brandon Bonfelt, Research Analyst at Marquette Associates, and I'll be covering the U.S. economy. 2020 ended in a fashion suitable for such an unprecedented year. COVID-19 active cases have climbed to over 20 million worldwide, the highest ever, as vaccine distribution gets underway. In a surprising turn of events, Democrats have taken control of the Senate via the tie-breaking vote of Kamala Harris. Equity markets set new highs, and unemployment remains steady, but elevated relative to pre-pandemic levels. Over 90 million cases of COVID-19 have been reported worldwide. Active cases are the highest they have ever been, though this number is expected to come down as vaccines have begun being distributed globally. Democrats won both seats in the Georgia runoff election, resulting in a blue wave scenario where Democrats control the presidency, the House, and the Senate. This win will allow the Democratic Party to more easily pass their legislative agenda through the process. Expect corporate tax rates to increase and an increased progressive income tax for the highest tax bracket. Most of the country has reopened despite active cases of COVID-19 being higher than they have ever been. The West Coast remains under tight restrictions. Vaccine acceptance and wearing masks are crucial to curbing the spread of COVID-19 and will play a large part in how quickly the rest of the states begin reopening. Israel approved and distributed the vaccine much more quickly than any other country and has inoculated 75% of their citizens over the age of 60. They also received the vaccines 3 weeks earlier than other countries, as they paid almost 3 times as much as the United States for each dose. As a result, more than 20% of Israelis have been vaccinated, versus the much lower 3 and 2% of the UK and United States respectively. Weekly unemployment claims have remained much lower than the peak of nearly 7 million in March, but are still much higher than pre-COVID. We are tracking this data closely and are looking for hiring to pick back up in 2021. The output gap is negative, indicating that companies are operating below their maximum potential. If hiring picks back up, we expect the output gap to move closer to zero. Compared to both the Euro area and developed markets as a whole, the United States has a smaller output gap. Through all of the turbulence in 2020, U.S. equity markets have bounced back and have been performing well after the election. Small caps have benefited from additional stimulus, and even more stimulus is anticipated, as Joe Biden's election win and the blue wave provide a tailwind for smaller businesses.
Hi, I'm Ben Moore, Marquette's Director of Fixed Income. We'll cover a quick review of fixed income in 2020 and then turn to what we expect for fixed income in 2021. The year began with COVID reaching our shores during the first quarter, which culminated at the end of March with panicked selling as investors crowded into a cash dash that dried up liquidity. Markets fell, with the 10-year falling from 1.92% at the beginning of the year to a low of 0.76% as panic swelled on March 23rd. The government provided unprecedented support at breakneck speed, aiding the markets with ample liquidity as spreads gradually tightened and flows returned from April throughout the end of the year. In the summer months, vaccine progress and lockdowns that contained cases drove the 10-year to a peak of 0.91% on June 5th. But as the second wave hit with social distancing fatigue and back to school, the 10-year once again fell, this time to the record low of 0.52% on August 4th. The 10-year ended the year at 0.93% after Biden's win. Emergency authorizations were given for the vaccines, and the $900 billion stimulus was signed. As shown here, the AG returned 7.5% in 2020 as bank loans returned 2.8%. High yield returned 7.1%, and emerging markets debt returned 5.3%. With the start of 2021 comes the hope that we are now heading into the recovery phase of the COVID pandemic, which is expected to feature the gradual adoption of the vaccine as well as a slow return to normalcy. Top of mind questions among investors with respect to fixed income include the extent to which the yield curve may rise and steepen and the extent to which credit spreads may further tighten. Investors are already attempting to forecast inflation and deciding whether and how to hedge against inflation if it rises. Lastly, investors are looking for signs of a bubble across market indicators amidst the slight blue wave that may deliver additional stimulus. Without a doubt, the biggest drivers of fixed income performance in 2021 will be the COVID recovery and what Biden and a narrow Democratic majority Congress could enact during the new administration's first year. As shown here, the yield curve steepened slightly with the emergency authorization and rollout of vaccines, as well as the signing of the relief package, despite rising cases. With the Biden presidency and a narrow Democratic majority in Congress, we expect smaller scale fiscal support for the recovery, as well as similarly scaled back higher corporate and personal tax rates and entitlement spending. In terms of the deficit, interest rates, and inflation, a wider Democratic majority would have likely resulted in larger stimulus that would have worsened the deficit and elevated short-term U.S. growth prospects, thereby boosting inflation, raising rates, and steepening the yield curve, at least in the near term. But the higher taxes would have likely been deflationary, depressing rates and flattening the curve in the longer term. However, with a narrow Democratic majority in the Senate and House, these new measures are less likely to be passed, or at least likely scaled down, and therefore we expect more moderate deficit increases, inflation, rate rises, and yield curve steepening in the near term that may just be the result of the recovery from the pandemic rather than policy. Related to the low yields is persistently low inflation. Market implied inflation, as shown here, is still below realized inflation, showing investor pessimism. The expected trajectory for inflation remains low given the overabundance of oil, which factors into the cost of all goods, the flexibility of oil producers to turn on rigs, and the growth of the services and technology sectors that rely less on commodities. As the blue wave moves to push a next pandemic relief bill through Congress, an important next question to ask is, how much runway do we have? As we can see here, we still have ample runway for further stimulus, although the balanced Congress may put a damper on the size and frequency. U.S. government debt declined from 135% to 127% of GDP in 3Q, still lower than Japan's 200%. Our debt to GDP is approximately where Japan reached in 2009 as it came out of the global financial crisis. We expect that the U.S. government can issue more debt because, one, rates are so low, any incremental debt will not amount to much additional interest expense. And two, the world will continue to depend on Treasury bonds as safe havens and demand should remain high. The blue wave has ample runway for further stimulus spending to support U.S. businesses and consumers. We will take a closer look at the corporate side in the following slides and focus on the consumer side here. How is the U.S. consumer doing in all of this? This chart shows that the average U.S. consumer is in increasingly better shape as delinquencies across all debt types have recently declined. Mortgage and HELOC delinquencies remain low, but credit card and auto loan delinquencies are elevated. Student loans have been supported by the CARES Act deferred payments. U.S. consumer distress is also on the decline. While not shown here, we track on a monthly basis foreclosures and bankruptcies, which remain very low and are declining. The congressional stimulus packages continue to work, at least for now. Core bonds remain a key component for diversified fixed income portfolios. They provide principal protection in market corrections. Yields are expected to rise and the yield curve is expected to steepen, but only slightly and gradually, as there are deep structural dynamics that continue to exert downward pressure on interest rates, especially the long-term retirement demographic. Credit downgrade and fallen angel activity continue to remain low at pre-pandemic levels. We recommend at this point maintaining strategic allocations to core bonds through 2021 as the anchor of an overall diversified portfolio that provides steady income and principal protection. Similar to core bonds, bank loan and high yield strategies are likewise more focused on bottom-up security selection while also focusing on beaten-up credits in the COVID-stricken industries that could see further spread tightening. As shown here, high yield spreads are now tighter than average. Bank loan spreads are at average, while EMD spreads are still showing some value. Sub-investment grade quality segments have roughly come full circle and then some in 2020, ending the year with gains across the board as shown here, despite the pullback in the spring. Similar to the 2008 housing crisis, all ratings quality segments initially fell in lockstep, with dispersion later realized that investors tilted up in quality. This time, recovery has been much faster, and the markets are already pricing in recovery with all quality segments in the black. Sub-investment grade industry bifurcation is still there, but all continue to gradually rally as shown here. During this crisis, energy, aerospace, and gaming and leisure have been the worst hit so far, with food and drug, utility, and technology having held up the best. During the 2008 housing crisis, financial services were hit the worst, but rallied the most by the end of 2009. Issuers continue to be very defensive in how they are managing their balance sheets in terms of new bank loan and high yield issuance. Based on the credit barometer that we track monthly, the use of proceeds towards acquisitions and LBOs for both high yield and bank loans have declined, and the CCC and second lien issuance levels are now very low. Bank loan and CLO issuance is making a comeback, supporting bank loan spreads and prices. Investors wary of declining yields kept supply in check immediately following the March 2020 panic, but normal levels have returned. Moreover, maturity walls for both bank loans and high yield, the amount of principal due in future years, are still pushed out, providing support for any near-term stress and any need for issuers to issue more debt to shore up cash balances. Fallen angels have been low since spiking in the first quarter, although we are seeing a pickup in investment-grade downgrades. As the recovery continues, we may see a few more stragglers being downgraded, but the general expectation is for the trend to remain low. As shown here, defaults are plateauing as the recession eases into a gradual economic recovery. During the 2008 housing crisis, spread tightening started much earlier than default peaks. In summary, we expect bank loan and high yield spreads to further tighten back down to all-time tights as early as potentially the first half of 2021. Bank loan and CLO issuance sprang back to life in 3Q20 and 4Q20 as demand gradually returned and the trend continues. Bank loan and high yield maturity walls are still pushed out, and new issuance use of proceeds is still benign, but leverage, coverage, issuance, and outstanding levels are now at cautious levels. Biden's pro-trade policies may result in furthering the trade deficit and a weaker dollar, and his push for more investment in U.S. infrastructure could raise imports of commodities from emerging economies. These could potentially both be tailwinds for emerging markets debt. Furthermore, tax hikes and deficit entitlement spending may be expected to weaken the dollar. However, the narrow Democratic majority in Congress may mean that the scale of these policies could be restrained. In terms of valuations, as shown in a previous slide, emerging markets debt spreads are roughly at long-term averages. While emerging countries on average continue to enjoy higher long-term growth rates and lower debt-to-GDP ratios versus developed countries, their access to vaccines may lag the developed world. We would expect their spread tightening to lag U.S. credit spreads. Shown here, the emerging markets debt maturity wall is looming relative to that of U.S. banks in high yield and may pose near-term stress and liquidity concerns if there are any hiccups in vaccine distribution and adoption as they get rolled out in emerging countries. In summary, emerging markets debt still represents a moderate value as their spreads are still near long-term averages, and they will have an intrinsic lag to their spread tightening as the vaccines may likely reach emerging countries after they reach developed countries. Near-term risks for EMD are elevated due to the looming maturity wall. As regards to the technicals, in other words, investor asset flows, investment grade and high yield debt have seen positive inflows and investors averaged in given attractive spreads. Emerging markets debt has just broken above break even, but bank loan flows are still net negative. We would expect bank loan flows to rise with further recovery from the pandemic. In summary, 2021 is expected to be largely shaped by vaccine distribution and adoption, scaled back policies from the slight blue wave, and a return to at least some level of normalcy. The yield curve is expected to rise and steepen slightly, but not that much due to strong long-term retirement demographic dynamics holding rates down. The general background remains positive. Key indicators have been showing an acceleration of industrial and manufacturing activity since March of 2020. The recovery is well underway, and we would expect the recovery trend to continue in 2021 as fixed income strategies position portfolios with a focus on COVID recovery names. We expect inflation to revert slightly upwards to more normal levels, as the Fed would be expected to allow inflation to be higher than targets. Valuations are expected to become more and more stretched across all fixed income asset classes, and spreads are expected to reach all-time tights rapidly, perhaps as early as the first half of 2021. There is no expectations for spreads to widen, holding all else equal. The only way spreads might widen is for an unexpected idiosyncratic event, and we must manage for this uncertainty. Investor sentiment remains strong, and the recent increasing reach for yield in BDCs and SPACs, blank check companies, are a sign of a growing exuberance. A key concern here is that the accommodative policies may be withdrawn as we reach full economic recovery, which may lead to an eventual correction. Lastly, volatility remains elevated with uncertainty as to vaccine rollout and relief stimulus. In general, we recommend maintaining strategic allocations and moving towards underweights for each plus sector asset class as their spreads tighten back down to all-time tights throughout the gradual recovery.
I'm Colleen Flannery, and I will be reviewing U.S. equities. We entered 2020 pretty optimistic. The Phase 1 trade deal passed, and late cycle interest rate cuts were expected to support positive market returns and earnings growth in 2020. In hindsight, the global COVID-19 pandemic tossed all expectations by the wayside and weighed on U.S. equity markets early in the year. The S&P 500 fell 33.8% in the span of just 23 days, marking the quickest descent to a bear market in history. However, the rebound was just as historic. By early August, the index exceeded its February all-time high, and just like that, the shortest S&P 500 bear market ever concluded. The index returned 18.4% for the year and ended at an all-time high, a rare occurrence, with 2020 marking just the 8th time this milestone has occurred since 1928. Across the market cap spectrum, history has been made for a multitude of indices. The fourth quarter marked the strongest return ever for the Russell 2000 index, isolated predominantly in the month of November, again the strongest month on record. This robust rebound ultimately resulted in the Russell 2000 index outperforming the S&P 500 for the first full calendar year since 2016. From a factor perspective, the return disparity between value and growth stocks continued and unfortunately deepened. The low single-digit returns for value indices across the size spectrum pale in comparison to the 30% plus returns of growth, and ultimately, the Russell 1000 Growth Index led the pack, returning 38.5% and logging the strongest annual return since 1998. With growth style leading the way for 2020, it's no surprise to see what really drove performance for large cap securities. FANG, Facebook, Apple, Amazon, Microsoft, and Google, the 5 largest companies in the S&P 500. These tech giants, largely favored in the stay and work from home environment, produced a 55.3% return for the year, more than 5 times the return of the rest of the index. These behemoths now comprise more than 22% of the S&P 500 and, more notable, 36% of the Russell 1000 Growth Index, a stark contrast from the beginning of the year when these levels were 15% and 29% respectively. While it's clear secular growth stories were favored in 2020, not illustrated in this chart is the cyclical rebound experienced in the final months of the year. Fourth quarter presented a factor rotation typically seen in the early innings of a new bull market. As news of a viable vaccine broke in November, expectations for a rebound in domestic productivity sent economically sensitive areas like small cap and value-oriented stocks surging. So much so that the all-time high for the Russell 2000 index, previously set in August 2018, was broken in mid-November. While fourth quarter factor performance was dominated by value, size, and yield leadership, it wasn't enough to counter the persistent factor trends of the first 3 quarters of the year. Ultimately, returns in the Russell 1000 universe were largely driven by growth, quality, and momentum factor leadership. U.S. equity markets began 2020 relatively calm, but the outbreak of the coronavirus brought with it a spike in the CBOE Volatility Index, also known as the VIX. The indicator skyrocketed above 80 in March amid the stock market downturn, a level that had not been reached since the global financial crisis. Since that time, volatility has reverted back to more normal levels despite several waves of spiking infection rates and a U.S. presidential election. It is likely that the largest source of market volatility in 2021 will be the effectiveness of a nationwide vaccine distribution plan. A smooth rollout would be a boon to equities and allow for continued economic reopening, but any delays or surprises in the immunization process could carry downside market risk. Unsurprisingly, corporate earnings were negatively impacted by the coronavirus pandemic. Value-oriented sectors like energy and industrials saw their earnings fall significantly in 2020, while growth-oriented sectors like healthcare and technology managed to eke out slightly positive earnings growth numbers. The estimated 2020 earnings decline for the S&P 500 as of the start of the year was 13.3%. However, as clarity regarding fourth quarter earnings increases, analysts have been revising this figure upwards. The fall in EPS growth, which had been going on since 2018, indicates the recent S&P 500 performance has been driven entirely by multiple expansion. Many analysts expect corporate earnings to rebound in 2021 on the back of new stimulus and a successful vaccine rollout, particularly for those companies in cyclical sectors of the market. Next, I will turn it over to my colleague, Evan Frazier, to finish the U.S. equities outlook.
Hi, I'm Evan Frazier, and I'll be finishing up the U.S. equity section of this presentation. Despite muted corporate earnings in 2020, most S&P 500 sectors saw positive returns during the year. The information technology and consumer discretionary spaces led the way, posting returns of 44% and 33% respectively. These sectors largely benefited from remote work environments and stay-at-home orders brought on by the coronavirus pandemic. Value-oriented sectors like utilities and financials, both of which were flat to negative in 2020, have struggled in the face of the coronavirus outbreak in a sustained low interest rate environment. The energy sector was hit especially hard in 2020, a year marked by a 25% drop in global demand for oil and a plunge in the price of crude at the onset of the pandemic. Energy returned a dismal negative 34% for the year, despite being the highest returning S&P 500 sector during the fourth quarter. Rising rates and a continued economic reopening should serve as tailwinds for these cyclical sectors going forward. U.S. equity market valuations are elevated across the size spectrum. The Russell 1000 index, which tracks U.S. large capitalization stocks, traded at 27.3 times earnings at the end of 2020, an extreme level relative to historical norms. Other metrics like price to book, price to sales, and price to cash flow indicate the current market for large cap stocks is expensive relative to history. The same can be said for the mid and small cap spaces in general, where multiples reflect a high degree of exuberance on the part of investors. Interestingly, one area of the domestic equity market in which valuations are not exorbitant is the small cap value space, which exhibited a PE ratio of 15.9 at the end of 2020. This multiple, which falls into the 64th percentile of historical levels for the asset class, may indicate that smaller, more cyclical companies have additional room to run from a multiple expansion or stock price gain standpoint. The equity risk premium, which compensates investors for market uncertainty, compressed slightly in 2020 as the earnings yield on the S&P 500 dropped in tandem with the 10-year Treasury yield. That said, the premium remains positive, making equities attractive relative to fixed income securities. This may explain why market participants have not shied away from stocks despite extreme valuations, otherwise known as the TINA phenomenon, whereby investors believe there is no alternative to equities in low interest rate environments. Going forward, rising rates could lead to an even narrower premium and put downward pressure on equity prices barring a commensurate rise in corporate earnings. It is certainly fair to say that not many would have predicted double-digit returns in 2020 for the S&P 500 in February and March, when the index shed roughly 35% of its value. Last year's strong performance was largely driven by multiple expansion, given the hit to corporate earnings as a result of coronavirus-induced economic shutdowns. Though 2020 was mostly dominated by tech names, increased political certainty and effective COVID vaccines have led to a resurgence of smaller, more cyclical stocks in recent weeks, and future stimulus, in tandem with rising rates, may lead to a continued value rally. Stretched valuations pose a risk to equity investors going forward, especially if 2021 earnings do not live up to expectations. Continued uncertainty surrounding the coronavirus pandemic also represents a threat to equity markets in the near term. With these risks in mind, we remain cautiously optimistic about the prospects of U.S. equities heading into 2021.
I'm David Hernandez, and I will cover the non-U.S. equity section. After an impressive 2019 when most broad benchmarks produced double-digit gains, our expectations for international equity market performance in 2020 was cautious. However, no one could have anticipated a global pandemic reminiscent of the Spanish flu, nor the full-scale economic shutdown, rapid market drawdown, and steep recession that followed. Despite the pandemic-induced market volatility, international equities saw a sharp rebound in the second quarter that carried through most of 2020. Emerging markets outpaced developed markets, and small-cap stocks beat out large-cap stocks. In the coming charts, we'll look at some 2020 trends and discuss whether they will carry forward into 2021. We will also review some key risks and provide our thoughts for this year's expectations. First, however, let's review how the 2020 rebounds compare to previous bear market rebounds. After a sharp sell-off in February and March, global equities found their bottom on March 23rd. The S&P 500, MSCI EAFE, and MSCI EM indices were all down more than 30%. In response to the COVID-19 crisis, central banks and governments throughout the world took aggressive action. Several emerging and developed countries cut their key interest rates in the first quarter, and that trend continued. The supportive monetary policy was paired with aggressive fiscal policy. The historically conservative country of Germany stepped up with a $1.4 trillion stimulus package. The European Union coordinated a $900 billion relief package financed by joint debt. This was the first of its kind. This support, coupled with progress on a COVID-19 vaccination, boosted investor confidence. From March 23rd, the MSCI EAFE returned 61%, and the MSCI EM index returned 73%. How does this compare to other bear market recoveries? For the MSCI EAFE index, there have been 8 bear markets with an average 1-year post-bear return of 41%. Now, the current drawdown of 33% was around historical averages, but the 61% recovery is second only to the global financial crisis, so it was a very strong rebound. For emerging markets, the drawdown of 32% was below the average, but the 73% rebound was very close to the historical average. We still have 2+ months before we hit the 1-year post-bottom date, so it'll be very interesting to see how these returns play out. A key positive for future returns is an expected rebound in economic activity. With shutdowns occurring throughout most of last year, 2020 GDP projections plunged throughout the world. The growth rate is expected to come in at -4.9% for 2020. And this is well off the International Monetary Fund's October 2019 projection of +3.4%. However, now that we have made tremendous progress on the vaccine front, markets anticipate a steady reopening of global economies, leading to a rebound in economic activity. We see a similar trend on the earnings front, where growth rates are expected to bounce back from a terrible 2020. Both of these events would be very supportive for future equity returns. Now, speaking about equity returns and earnings growth, over the last 3 calendar years, we have seen a strange trend for both the MSCI EAFE and MSCI EM indices. For each calendar year, the equity return has been the opposite of the earnings growth rate. In this chart, we're showing the emerging markets, and as an example, in 2019, the EM index saw a negative earnings growth rate of 14.7%, but returned a positive 18.4%. A similar relationship held in 2018 and 2020. However, between 2015 and 2017, equity returns followed earnings growth much more closely. Both were positive and or negative at the same time. With 2021 expected to see strong earnings growth, equity investors hope the recent trend does not continue. As shown on the previous chart, the last 2 years we have seen strong equity returns despite poor earnings growth. When price goes up and earnings go down, valuations become more expensive. Since 2019, the trailing PE ratios have risen 75% and 82% for the MSCI EAFE and MSCI EM indices, respectively. Looking forward to 2021, earnings are projected to be much stronger, with estimates ranging from 30 to 35%. Now, it's important to note, however, that these are projections, and it is common to see projections come down throughout the year. One can certainly make an argument that these current valuation levels are supported by an extremely low interest rate environment. However, since the start of 2019, there's certainly less wiggle room for multiple expansion, and that gives us a cautious outlook on returns for 2021. As promised, now we'll discuss some recent trends in 2020 that we think can continue into 2021. The first 10 months of 2020 saw a historic run for growth stocks. While growth has been performing well the last several years, the trailing 1-year spread between growth and value hit historic levels. In October 2020, the difference was the largest we have seen since 2000. The COVID environment produced clear winners and clear losers, with cyclical stocks underperforming as global economies shut down. Financials struggled as central banks cut rates in reaction to the global crisis. In contrast, internet-based companies flourished as consumers across the world stayed home. In November, news of a vaccine progress spread, and we saw value stocks begin to rally. We expect that rally to continue, as these stocks typically outperform in the early part of the economic recovery. However, we are cautious on the sustainability and duration of that rally given the low interest rate environment. A rise in interest rates coupled with consistent global economic growth would give us better confidence in sustainability of outperformance for value stocks. So to sum that up, the recent value rally, we do expect that to continue in the short term, but are cautious on the sustainability of that rally. While the last 10 years has seen strong performance from growth stocks, it has also seen a change in investment landscape for emerging markets. The top 10 companies are no longer dominated by commodities or financials, and instead, there are more investment opportunities in companies that are capitalizing on technology trends that played out in the United States. E-commerce, online payment processing, and social platform businesses serve as key examples. The MSCI EM index now has a 20% weight to IT compared to 28% for the S&P 500, and only 8% and 14% for Europe and Japan respectively. While the S&P 500 has the highest IT exposure, it also has the lowest exposure to cyclical stocks, and these exposures are a key reason why the S&P 500 has outperformed all other broad equity indices. Breaking down that 20% IT exposure for EM, we see that the majority reside in EM Asia, which has 25% in IT. In comparison, LATAM and EMEA have only 2% and 0% respectively. The trend of increased technology exposure has helped lead to greater benchmark concentration for the MSCI EM index. The largest 5 companies comprise 23% of the benchmark, a greater degree of concentration than the S&P 500. Similar to the US benchmark, the EM top 5 is comprised of IT, consumer discretionary, and communication service companies. These companies and other internet-based businesses have benefited as long-term consumer trends were sped up due to the stay-at-home environment. Many investors expect these newly formed consumer habits to remain in place even as economies reopen. We believe these trends are likely to lead to more internet-based investment opportunities as well as higher benchmark concentration in EM. The final trend we will talk about is trade relations. After 4 years, a Brexit deal was finally made on Christmas Eve. What a great Christmas gift. Both regions were able to retain 0 tariffs in a deal that largely covers goods and stated commitments to protecting social and labor rights, as well as efforts to mitigate climate changes. This is still a less than ideal arrangement with an end to free movement of citizens that may lead to delays and disruptions in trade movement. This was not the only trade relations issue. Despite signing the Phase 1 trade deal last January, the US-China trade war continued and was contentious throughout 2020. Both countries escalated beyond trade threats to accusatory claims on failure to stop COVID-19 spread, regulatory moves aimed at protecting market share, and blocking each other's companies. While it's anticipated that the tone will temper under the new administration, it is also anticipated that the Biden administration will remain tough on China. We've also seen trade disputes between the US and Europe with an exchange of tariffs from both sides. This year, we expect these trade issues to continue as the new US administration deals with the current trade reality between the UK and the European Union. This introduces some potential hiccups for a rebound in global economic activity. Let's wrap up the non-US equity section. Vaccine progress and a coordinated effort around fiscal and monetary support led to strong equity returns despite poor economic growth and earnings growth. Valuations, they're currently at historic levels. However, low interest rates are supportive of valuations. Looking forward, earnings expectations are high for this year, and how much of that is currently priced in? Value stocks came back at the end of the year. We think that this can continue as we start to see the early portion of an economic recovery. However, we're less confident over the duration of that rally. Investment opportunities in EM have changed, have become more technology driven, and we do expect that trend to continue. Will we see a rollback in global trade relationships? That's something we've seen in 2020, and we do think that that serves as a potential risk for a rebound in global economic activity.
Hello, I'm Joe McGuane, and I'll be covering hedge funds today. Let's get started. Hedge funds surged during the final month of 2020 to close out a volatile year with strong performance. Equity long short was the strongest strategy in 2020, as these managers were well positioned both on the long and short side for volatility. Convert ARB was the second strongest strategy, as his previously sleepy strategy saw a renewed opportunity set. It was the perfect storm of heightened market volatility, near zero rates, and tight spreads. Event-driven had a positive year, though some deals did fail. Many more prevailed, and the corporate transaction market was back to pre-crisis levels by the second half of the year. Macro strategies finished the year positive as managers were able to capitalize on the year's economic and political turbulence. Equity allocations contributed positively post the sell-off in March as central banks around the world stepped in to support markets. Through March, equity hedge managers were down 13%, holding up better than the S&P 500, which was down almost 20%. Through the pullback, managers cut exposures, meaningfully reduced gross and net leverage, and generated strong short alpha. Funds were quick to add exposure back for the rally and ultimately generated record levels of long alpha. All in, total net alpha for global long-short funds in 2020 was the strongest in history. One of the main contributors to returns in December were the crowded stocks, particularly those in North America and Asia. Longs were the main drivers in both regions as North American longs outperformed the S&P by 3.7% for the month, and Asian longs outperformed the MSCI Asia Pacific by 6.5%. Crowded shorts also worked in North America and Asia, underperforming their respective indices by greater than 2%. Hedge funds were able to generate alpha across most sectors except for energy, real estate, and financials during 2020. Long-short hedge funds were net sellers of global equities in the final month of the year, with the selling being the largest seen since April 2020, when hedge funds were selling into the initial market rebound. Most of the selling in December can be attributed to short additions, which were concentrated almost entirely in North America. After a mixed year in 2020, volatility risk premiums are starting 2021 from a position of strength. Early losses in 2020 held back full-year returns, but market conditions after the extreme moves down and up created a favorable backdrop for VRP managers. The VIX index remains above average, while realized volatility in the S&P 500 has now fallen below average, creating an above-average volatility risk premium spread. Managers expect this backdrop to remain through 2021 as the market reconciles valuations near highs with the uncertainties of a vaccine rollout, a new administration, and a global recession. This chart shows the percentage of loans and CLOs trading below $80, a key metric for stressed loans. At the end of March, over 30% of loans in CLOs were trading below $80. Though loans were not backstopped by the Federal Reserve, they bounced back with both equity and debt markets for the remaining 3 quarters of the year. December ended at a low of 2.54% of loans in CLOs trading below $80. Overall, hedge fund performance was at the highest level we have seen since 2009. A large driver of that dispersion year-to-date occurred in March, which was the single largest month in terms of dispersion since October 2008. The year-to-date dispersion was driven by both very strong performers but also fairly weak performers on the lower end of the spectrum. And finally, as investors consider the implications of equity valuations at highs and rates near lows, we recommend an allocation to hedge funds. Alternatives play an important role in portfolios, especially when opportunities in traditional asset classes may be more limited. We recommend long-short equity managers with a proven stock-picking track record that will have an edge in 2021. Credit managers that go both long and short should be positioned to generate alpha. M&A activity is expected to remain elevated, creating more opportunity for merger arb funds. Convert arb managers are primed for another solid year if rates stay low and volatility remains high.
My name is Will Dupree, Senior Research Analyst for Real Assets and Infrastructure at Marquette Associates. And this is the 2021 market preview for private real estate. After a significant drawdown in Q2 2020, private core real estate saw slightly positive returns in Q3. Returns were primarily driven by the industrial sector, and apartments were a modest contributor. Q4 returns are expected to be similar to those of Q3, and calendar year performance for the MPI and Odyssey indices is expected to be flat to slightly positive. Performance dispersion across sectors and subsectors had been increasing in recent years, and it has accelerated significantly during the pandemic. At the immediate onset of COVID-19, the dispersion between write-ups and write-downs was at its highest point since the '08 crisis. And as of 3Q 2020, dispersion across all sectors and subsectors reached an all-time high. Much of this was due to virus prevention measures and pandemic-driven behavior, creating tailwinds for some property types and headwinds for others. Thus, performance variation across property types should decrease from its high point post-pandemic, but it's also likely to remain strong and evident for some time. This is because many of the pre-COVID trends behind this dispersion, such as secondary and suburban market migration, are expected to continue post-pandemic, as are many recent pandemic-driven behaviors, such as online grocery shopping, which will become a permanent habit for many of us in years to come. It's also likely that this performance dispersion is reflected in 2021 Odyssey Manager performance, which could reflect a clear separation of winners and losers based on favorable or unfavorable sector biases. No two sectors tell the story of dispersion better than industrial and retail. Since 2017, the two have been on polar opposite points of the return spectrum. The driver of this? Booming e-commerce. The growth of online shopping has created an inverse relationship between the two sectors, driving industrial demand upward and retail simultaneously downward. Virus prevention measures significantly increased the momentum of this trend in 2020 as more were forced to shop online. Although distribution of effective vaccines will bring many consumers back to shopping centers, we believe industrial and retail will continue to expand and contract respectively through 2021 and 2022. In the coming years, we expect more malls to vanish. However, those specializing in experience retail or luxury goods may remain viable. On the other hand, many grocery-anchored retailers held up well in 2020 for their ability to successfully integrate e-commerce platforms. In 2021, many of these properties could see post-pandemic tailwinds, but the strength of these will very much depend on the strength of their inline tenants. Just as retail has been disrupted by technology, so too has office. Since 2013, the number of office employees working from home has been moderately increasing, but this number is likely to surge significantly post-pandemic. This poses a problem for landlords as many tenants ponder whether to reduce their office footprints and thus overhead costs. Lease rollover percentage remains a key data point for 2021, as landlords will now pursue lease renewals more aggressively in order to protect the value of their buildings. Despite early rumors of a massive office exodus, we believe this is very unlikely. According to a recent Gartner survey of 317 CEOs, 95% of them plan to bring over 50% of their workforce back to the office full-time. However, 13% of them also indicated that they had already made cost reductions associated with office footprint reductions. Without hard data, we cannot estimate with certainty how many tenants will reduce their office footprints, but we do anticipate a handful of reductions occurring. Various stats, such as difficulty of implementing social distancing on public transit, large suburban workforces, and increasingly unfavorable corporate tax regimes, imply gateway markets are more exposed to this risk than others. In 2021, we expect gateway markets such as New York City, Chicago, and Houston to contract, while secondary markets like Nashville and Austin should continue to expand per increasing population and tech job growth. However, gateway markets have shown resilience in the past and should rebound strongly in later years. The above slide represents our bird's eye view of where different property types may be in the current cycle. As stated earlier, we expect retail and gateway office to continue contracting and expect industrial to continue expanding. High-rise apartment as well as student and senior housing should also experience early pressure, but could rebound in later quarters depending on successful vaccine distribution. Leisure hotels could also experience a similar snapback. However, business hotels should continue struggling as corporate travel is unlikely to return to pre-pandemic levels. Also stated earlier, many grocery-anchored properties should recover post-pandemic, and suburban apartments should continue to rally as millennial migration continues. One important trend to watch in 2021 is the growth of alternative sectors, which have gradually become a larger part of the Odyssey since 2018. In 2020, cold storage and data centers rallied on the backdrop of online grocery shopping and work-from-home mandates, respectively, while life sciences and medical office property values were driven by increasing R&D expenses, biotech innovations, and a larger aging population. These sectors are all well positioned to continue rallying in 2021. We believe these properties will be small but significant drivers of core manager returns in 2021 and may provide compelling opportunities for value add and opportunistic portfolios moving forward. We expect private capital fundraising to increase significantly in 2021. A recent Preqin survey showed a significant year-over-year increase in the number of investors and fiduciaries planning to allocate to value-add, opportunistic, real estate debt, and distressed strategies, and a significant decrease in those planning to allocate to core and core plus funds in 2021. It's thus clear that many investors are now looking to capitalize on the short-term dislocations created by the pandemic, and the recent significant increase in redemptions in core strategies implies that much of this capital could be coming from existing real estate holdings. As we evaluate these opportunities in 2021, we believe it's important to temper post-pandemic expectations for many property types. Successful vaccine distribution could indeed create immediate recoveries for some property types. However, others are due for longer recovery periods, and some may never return to their pre-pandemic demand levels. And this is the 2021 market preview for private infrastructure investments. This chart looks at the historical income and capital appreciation of the MSCI Global Infrastructure Index. While 2020 performance data shows a slight decline from the returns of previous years, infrastructure has held up well relative to other alternative asset classes, such as real estate. 2020 returns have mainly been driven by the durable income of the asset class. In a world of yield scarcity, this should make the asset class even more popular with investors in 2021. The 2020 decline in capital appreciation was mainly driven by GDP-sensitive assets, such as airports, ports, highways, and oil gas rigs, as the pandemic led to sharp declines in the usage and commodity prices that are positively correlated to these assets' revenue streams. In 2021, we expect each of these assets to rebound as vaccines are distributed and economic activity resumes. However, some assets will struggle to reach previous usage levels and thus valuations, such as airports, as travel activity is not expected to return to its previous levels. Looking at deal flow by sector, it's clear that transport has felt the pain of COVID-19, as sector deal flow is down 45% as of 3Q 2020. Alternatively, renewable energy has held up quite well, dropping only 13%, while conventional energy deals have declined by 44%. This cyclical resilience highlights the hedging potential of ESG assets and should increase investor appetite moving forward. As intermediate-term outlooks continue to look bleak for the oil industry, renewable energy continues to be a key driver of infrastructure investment. In the U.S., the recent blue wave of Democratic victories in the White House and Senate may also create additional momentum for renewable deal flow in 2021. However, historical data implies that this may not be as impactful as the public is perhaps anticipating. Nonetheless, we predict continued contraction for transport allocations in early 2021, which could provide tailwinds for not only renewable energy, but other infrastructure sectors as well. While the performance and deal flow of renewables has been impressive, no sector has shown more cyclical resilience than telecommunications. While private infrastructure data is still forthcoming, amongst listed infrastructure indexes, telecommunications was unquestionably the most resilient sector of 2020. For the calendar year, telecommunications was a top-performing sector and one of only two to generate positive returns. While deal activity declined from Q1 to Q2 by 28%, the sector saw a modest rebound of 5% from Q2 to Q3. Investors have likely now awoken to the defensive properties of this sector, and we expect an increase in investor appetite for telecom exposure in coming quarters. These defensive properties are also supported by data. Historically, IP traffic has shown low correlation with GDP growth, and this was fully displayed in 2020, as data usage significantly increased during the onset of the pandemic, despite Q2's 34% drop in GDP growth. In 2021, we expect continued growth of this asset class, particularly in North America, on the backdrop of emerging 5G networks, favorable M&A activity, and the political scrutiny of China-based network infrastructure provider Huawei. Because a significant number of telecommunication assets are greenfield assets, which historically see higher volatility, telecom is often underrepresented in open-end core infrastructure portfolios. However, the consistent growth in deal flow and asset valuations implies that the number of brownfield telecom assets will continue to increase, and these assets will become a larger part of core portfolios over the next decade. When assessing 2020 capital flows, we have noted two observations that provide some insight into what many investors are thinking. While fundraising rebounded significantly from 2Q to 3Q, only 60% of unlisted funds were able to raise capital in this period. And amongst the number of funds that closed in 2020, as of 3Q, there was a 30% increase in the number of funds that were in market for more than 18 months. Longer fundraising periods tend to be associated with larger funds and higher AUM targets. The combination of these variables implies larger funds are scaling a significant amount of assets from smaller managers, and that investors may now be placing a premium on scale and established relationships, likely due to the uncertainty caused by COVID-19. If this trend persists into the new year, it could have a potential impact across different fund types. In 2021, we could see larger closed-end funds acquiring capital at a more rapid pace. And we could see larger open-end funds experiencing greater demand and thus larger entry queues for new investors. In summary, we remain bullish on private infrastructure. It will only increase in popularity on the backdrop of economic uncertainty, growing inflation concerns, yield scarcity, and an attractive equity risk premium of 7.8%. However, investors should also remain aware of how 2020's events could impact the asset class in the short term and the long term. In the short term, the market appears to be placing a premium on manager scale, which could impact capital flows across different fund types. And many assets that saw short-term declines in value per pandemic-driven behaviors should bounce back by the second half of the year. In the long term, future American climate change policies could provide additional tailwinds for renewable energy assets and headwinds for conventional energy assets. Also, the telecommunications sector should continue to become a larger part of the opportunity set per increased demand for data and the growing awareness of its counter-cyclical characteristics.
I'm Derek Schmidt, Marquette's Director of Private Equity, and I'll be reviewing our 2021 outlook for the private equity industry. The private equity market performed mostly as expected throughout the economic volatility of 2020, with values dipping 10 to 20% in the first quarter and rebounding in the second quarter. Preliminary numbers for the second half of the year continue to improve and should allow for private equity to again experience another low to mid-teens return that has made the industry so coveted by investors. What really performed well was venture capital and growth equity in 2020. Investments in businesses with strong growth that either proved their durability during COVID or experienced a growth acceleration due to a pull forward of technology trends, which allowed these business values to increase. However, within all areas of private equity market, 2020 was a year where quality really mattered, both at the manager level and the underlying business investment level. The experienced managers that had been increasingly focusing their time and efforts sourcing high-quality businesses will have done well in an environment where the dispersion of performance is likely to be very wide. The private equity industry experienced a significant slowdown in fundraising activity in 2020 due to market volatility and a complicated fundraising environment in which travel restrictions were in place and most investors were working remotely. U.S. private equity managers were still able to raise $200 billion, but this was down 36% from 2019, as significantly fewer managers and strategies were able to raise capital. Experienced managers with established LP bases and strong track records were able to quickly raise funds virtually during 2020. However, New and emerging managers were more challenged, with the inability to get in front of investors for introductions and on-site visits that so many investors require. We believe as the vaccine rollout progresses, and we hopefully get back to a more normal lifestyle sometime in 2021, that the market will see fundraising rebound and broaden, with more managers, strategies, and larger funds being raised. Private equity valuations remained elevated throughout 2020, as business valuations have been pushed higher the last few years due to a combination of low interest rates, increasing competition, and a continued mix shift towards faster growing and larger businesses. However, there remains a growing valuation disconnect from the public markets, with the average private equity transaction in the U.S. middle market buyout space occurring at a 42% discount to the Russell 3000. Private equity managers continue to operate with a long-term business focus and investment discipline, which has provided investors comfort that the industry can continue to deliver the attractive returns, with most transactions occurring between 8 to 12 times EBITDA. It is difficult to see these elevated values reversing significantly in 2021, as competition from larger transactions is likely to continue, and increasing public valuations are being used to support these larger transactions. The late-stage venture capital market has grown significantly over the past few years, as businesses have continued to stay private longer and more capital has been available to these fast-growing businesses at a scale never before experienced in the venture market. This space didn't miss a beat in 2020, as technology adoption was pulled forward in many ways. The average late-stage business valuation was up 64% over 2019, as the largest assets across the venture space were in high demand, given a rewarding exit environment with large exits in 2021 of CrowdStrike, Snowflake, and Palantir. We believe valuations could expand further in 2021, with attractive exits already lined up, with Stripe, Coinbase, Robinhood, and Instacart likely to IPO. 2020 was perhaps the year of the SPAC. Despite historically being viewed as a niche investment vehicle, SPACs became one of the hottest topics within the financial community in 2020. Investors contributed $70 billion to 228 SPACs, an increase of 529% over 2019 levels. These managers typically have 24 months to deploy capital, which will make them active acquirers and likely accelerate the venture capital exit activity in 2021. SPACs raised in 2018 and 2019 were able to deploy about 59% of the capital they raised, which would imply over 120 exits to the public market on the horizon. It wouldn't surprise us if this number was even higher, given this vintage of SPACs has a higher quality of managers and business operators tied to these vehicles. So what are the private equity takeaways? 2021 is likely to be a bounce-back year for private equity fundraising. Managers are anxious to get in front of investors, and we would expect an increasing number of managers and strategies to be raised. Private equity valuations are likely to remain elevated in this low-rate environment, and further supported by a mix shift occurring towards larger and faster-growing businesses that often come at higher valuations. The late-stage venture market has experienced a lot of growth, due mostly to the trend of companies remaining private for longer and now being in an attractive exit environment. This has driven up valuations for attractive businesses, and these high valuations are likely to persist in 2021, as the public markets have continued to reward their growth. SPACs were a hot topic of 2020, raising $70 billion. These funds will now transition to deploying this capital in 2021 and 2022, providing an additional exit path for many venture capital-backed businesses. And finally, we believe we will continue to see private equity allocations rise in 2021, with broader utilization by institutional investors in a low interest rate environment.
Hello, I'm Brett Graffey, research analyst at Marquette Associates, and I'll be talking through the 2021 market preview for private credit. The first quarter of 2020, private credit had its worst quarterly performance since the fourth quarter of 2008, falling 6.1%. However, private credit did not experience as significant a drop compared to public credit indices like the Credit Suisse Levered Loan Index and the Barclays U.S. High Yield Index, which declined nearly 14% and 13% respectively. Alternatively, in the second quarter of 2020, private credit dropped 15 basis points, while the Credit Suisse Levered Loan Index and the Barclays U.S. High Yield Index bounced back nearly 10% for the quarter. In the coming months, as Q3 and Q4 2020 data becomes available, private credit investors will be anxious to see how their allocations performed compared to other asset classes. Most importantly, though, this was the first significant test for private credit since the Great Financial Crisis, which will provide investors with an important data point to compare managers and funds for years to come. In 2020, median U.S. buyout multiples fell slightly to 13.8 times, but equity contributions rose to nearly 80%, and total debt to EBITDA decreased to 3.1 times. Consequently, pricing improved as original issue discounts increased, LIBOR floors became the norm, and call protections expanded. This is a significant shift from previous years when the term covenant light became synonymous with the credit market. While interest rates fell in 2020, private credit loan rates have been supported by LIBOR floors, which we believe will benefit investors and be a hedge against potential rising rates. Lenders will use lessons learned during the COVID pandemic to strengthen their credit agreements and protect investors. We expect stronger documentation and increased equity cushions to persist in 2021 and will provide private credit investors with beneficial downside protections. Simply put, distress opportunities so far have not been as widespread as managers expected. In the leveraged loan and high-yield bond markets, securities sold off sharply in March but bounced back quickly, not giving managers enough time to deploy the amount of capital they had hoped. Similarly, the Proskauer Private Credit Default Index showed defaults spiking to 8.1% in the second quarter but falling to 4.2% in the third quarter, the same level as the first quarter of 2020. We expect this distress cycle to look very different due to record low interest rates, global accommodated central bank policy, and government intervention. Instead of a deep distress cycle, we believe this cycle will last longer, but not be as pervasive across industries like we saw in the Great Financial Crisis, and distress opportunities will instead be focused on specific industries like travel and leisure. Through the third quarter 2020, private credit was on pace to have its lowest fundraising total since 2014. Only 82 new private credit funds have been raised through that period, which would be the lowest figure since 2010. While private credit fundraising lagged compared to years past, total assets under management grew slightly to $786 billion, and dry powder rose to $293 billion. As investors encounter a new reality in a post-COVID world that includes record low interest rates and high equity valuations, we believe that 2021 fundraising will eclipse the 2017 record year. Investor demand for yield has never been greater, and private credit has proven itself as an attractive alternative for investors. We believe investor demand for private credit will boost fundraising activity for esoteric asset classes such as fund financing, consumer lending, and non-performing loans as clients seek diversification and yield-enhancing assets. Throughout our conversations with private credit managers in 2020, we were impressed by their ability to act decisively and work with their private equity counterparts to provide support for their businesses. In many cases, this led to beneficial outcomes for investors. Private equity sponsors value this support, which will likely lead to increased deal flow to loyal private credit lenders. Low interest rates and supportive Fed policy will lead to fewer distress opportunities, but amplified investor interest in private credit as the asset class continues to look attractive compared to other fixed income asset classes. It is the hope that we are past the worst of the COVID pandemic and life will soon begin to return to normal. Until then, market uncertainty will remain and private credit deal activity will persist below pre-COVID levels. As a result, private credit dry powder will likely grow as managers patiently wait for compelling investment opportunities. Furthermore, 2020 marked an important year for the maturity of the asset class that has grown significantly since the GFC. While 2020 brought along unforeseen investment challenges, Investors are upbeat about the prospects for 2021 and the hope that it won't be as tumultuous as the previous year. We continue to view private credit as a compelling and attractive asset class for institutional investors who can handle illiquidity in their portfolio.
Thank you for watching this video. We hope it has been a good use of your time and helped you prepare a bit more for what to expect out of the capital markets in 2021. We are here to help you with any questions you have, so please feel free to reach out if you have further questions. There are a variety of ways to contact us with questions. If you are one of our clients, please feel free to reach out to your consultant for more information. You can also send us an email. There are 2 email addresses listed here. We are happy to respond to specific inquiries, as mentioned in the first email address, or general inquiries, which is the second email address. Please don't be shy about reaching out to us. We're here to help you and your committees make the best decisions possible for your portfolios. Finally, next steps. Please share any feedback you have. We want these videos to be the best use of your time, so we welcome your input. You can subscribe to our channel for quarterly market insights videos, as well as other topical videos we produce during the course of the year. You can also register for research email alerts on our website. The full newsletters backing this video series are also available on our website. Last but not least, we will see you next time, and thank you again for spending some time with us today. Thank you.